Good morning and welcome to the Killik and Co Market Update. This week, the latest wage data for the UK has been published. Wages have been rising here in the UK, but so too have prices or inflation. So many people will not necessarily be better off after getting a pay rise once inflation is taken into account. Here on this chart, shown by the pink line, we've got growth in UK total pay, which includes salary and bonuses. And then shown by the green line, we've got growth in real pay, which is pay after inflation has been taken into account. You can see that in times of relatively low inflation, for example 2015, the two lines on this chart are quite close together. But for times of higher inflation, for example 2007 and now, the two lines are very far apart. You can also see that in 2020, when the country went into lockdown, there was quite a drop in wages because so many businesses were shut down and there was no need for staff. However, coming out of lockdown, businesses have been fighting to attract staff, particularly in certain sectors such as hospitality and deliveries, and that has led to a spike in wages. The good news is that for the most recently measured period, which is December 2021 to February 2022, there has been positive growth in real wages. They were up 0.4%. However, the bad news is that inflation is still rising. The latest figures were published this week. Inflation in the UK came in at 7%. And to add to that, the national insurance hike was introduced at the start of this month, so that could put a bit of a squeeze on some people's finances. It's also true that wage rises have not been constant across different sectors, and at the moment it's certainly true that wages in the private sector are rising much more quickly than those in the public sector. So there will certainly be a number of people across the UK who will be finding that their disposable incomes are falling, and that's definitely not good news for economic growth. Investment bank JP Morgan published its latest set of results this week, and Jamie Dimon, the chairman and CEO, struck a fairly cautious tone with some of his commentary. He said that we remain optimistic on the economy, at least for the short term. Consumer and business balance sheets, as well as consumer spending, remain at healthy levels, but we see significant geopolitical and economic challenges ahead due to high inflation, supply chain issues, and the war in Ukraine. JP Morgan shares have sold off a little bit recently. While the bank should benefit from rising interest rates because those will enable it to charge more on loans, the bank would be negatively impacted by a slowdown in economic growth and the corresponding slowdown in business activity. Looking at the chart, the shares are pretty much back to where they were in the months before COVID. So at the moment, it looks as though some investors are exercising caution rather than going into full-blown panic mode. A look at the US yield curve also suggests that some investors are exercising caution. The yield curve shows the interest rates available on bonds with different maturity dates, and normally you would expect a yield curve to be upward sloping, showing a higher rate of return for longer dated bonds, because investors would usually expect to be compensated more for locking their money up for a greater period of time. This chart here shows the yield curve at the moment and the yield curve where it was last year. So the purple line shows where the yield curve was a year ago. You can see it's a classic upward sloping shape. The green line shows where it is now, and it's higher because interest rates have gone up since last year, but it's also much flatter, with the rate on a 3-year bond not much higher than the rate on a 30-year bond. And that implies a bit of a premium for the shorter dated bonds, possibly because some investors are concerned about the current macroeconomic situation and they would prefer to be in bonds rather than equities for the time being, despite the fact that bonds are offering a below inflation return. An inverted yield curve, when shorter term rates are higher than longer term rates, can be an indicator of recession, so many investors will be watching the flattening of this yield curve very carefully. And finally, Amazon has introduced a temporary surcharge for third-party sellers using its platform. Amazon fulfills these orders, and the surcharge is there to cover the higher costs of fuel and the higher wages for warehouse and logistics staff. So it's interesting to see that even Amazon is feeling the pinch from higher costs at the moment. The third-party seller business is actually quite a big chunk of Amazon's revenue. As you can see by the pie chart here, which breaks down Amazon's sources of revenue, you can see that for the full year 2021, 21% of Amazon's revenue came from this third-party seller business. Moving on to have a look at next week, you can see us very busy on the corporate calendar as we move into the next quarterly reporting season. I hope you all have a great Easter weekend, and I look forward to seeing you next week.